Commercial real estate is probably the most negatively impacted asset class since the pandemic. The current economic environment, along with the questionable economic policy by the Fed and the rapid rise of interest rates, as well as people just simply not going back to the office as before, really has put the sector in a really bad situation, with people even calling the crash apocalyptical in scale. And unfortunately, it really appears that the situation is really far from over anytime soon. Now, this past week, several gloomy headlines just went largely unnoticed, but I think that they are more concerning than what's being reported right now. According to a new July report from McKinsey Global Institute, commercial real estate prices may crash as much as 42%, and these are some of the reasons why. First, the rise of hybrid work is the main cause for the decline in commercial real estate, and that's not really going anytime soon. According to the report, office attendance is down by 30% prior to the pandemic. And as of October of 2022, office workers were visiting the office just about 3.5 days per week. Now, McKinsey's research team really believes that this could be the case through 2030, so we have about 7 more years to go. And as the survey conducted revealed that the number of days per week that respondents go to the office is just about 3.5 days, while the number of days that they expect to go into the office after the pandemic ended is just 3.7 days per week. But the preferred number of days that employees want to go back to the office is just 3.2 days. All of these numbers are not far apart. However, the most revealing stat is that 10% of the people that they surveyed said that they were both likely to quit their jobs if required to work at the office every day of the week, and really willing to take a substantial pay cut if doing so let them work from home when they want it. Therefore, the reluctancy of workers to return back to the office full-time and having that full-time attendance is really likely to have a lasting effect on the commercial real estate sector. Now, McKinsey also conducted this study in several major cities around the world, but in the US cities that they analyzed, they found that the transaction volume, which is the total dollar value of all sales, fell by about 57%, while the average sales price per square foot fell by 20%, and asking rents fell by 22% just from 2019 through 2022. The research also found out that San Francisco, unfortunately, has the poorest outlook among all the cities across the United States when it comes to commercial real estate values, as the share of office space that was vacant was 10 percentage points higher in 2022 than it was back in 2019, while transaction volume was 79% lower and sales price per square foot were about 24% lower, while the asking rents were 28% lower. And really, this is not part of the study, but I really would believe that many of the bad policies against crime in California have a lot to do with this. And anyways, the falling demand will just continue to drive down the value of this commercial real estate assets. So this research just concludes with a couple of scenarios on how much prices can fall by. And on average, the total value of office space may decline by as much as 26%, and that's really from 2019 through 2030 in a very moderate scenario. But they might fall by as much as 42% in a more severe one. Now, the impact of value could be even stronger if rising interest rates continue to compound. So basically, interest rates just continue to go up. And similarly, the impact could be, much stronger if, some of these troubled financial institutions decide to more quickly reduce the price of the property that they finance or own. But not all office space will feel the declining effects. Now, properties classified as Class B and Class C will suffer the most declines in value. And these are basically lower quality and older buildings. Now, meanwhile, from 2020 through 2022, rents and the demand and even sometimes prices generally grew a little bit more or really just didn't fall as much for Class A buildings than for Class B buildings in some of these US superstar cities like New York City. That's a pretty good example, is that the average sales price per square foot rose by 3% for a Class A building, but for Class B buildings, that demand really fell by 8%. So basically, this sort of exemplifies that employers have an obvious belief that having these high quality spaces will encourage office attendance. But now with that being said, Morgan Stanley actually predicts that a 27.4 drop for all commercial property types through the end of just 2024. And to make actually matters worse, there's about a $1.5 trillion worth of commercial real estate debt that is coming up due by 2025. Now, this debt will need to be either refinanced or renegotiated. The problem is that no one really knows when the rates will start coming down for this to happen, so the crash can start to come down very soon. However, it actually might be starting to happen right now, and I'm going to give you a couple of examples why. And here where I live in Atlanta, Georgia, Starwood Capital Group just defaulted on a $212.5 million mortgage for a property called Tower Place 100. Now, this is a gorgeous building in the Buckhead district. I've been to this building many times. Buckhead is really one of the city's ritziest places. And if you live in Atlanta, if you live in Georgia, you know that obviously, Buckhead is Buckhead. And if you came to the city, you will know that, this is a very expensive part of town. Actually, Buckhead had some of the most expensive real estate in all of the state, and all of the South, as a matter of fact. But anyways, this mortgage matured on July 9th, and Starwood failed to refinance or pay off the debt on this property. Now, Atlanta also has about 8.7 million square feet of space available to sublease, and that actually represents a 218% increase from the availability of commercial real estate before the pandemic, and that's 43% increase since 2022. So just the way how commercial lending works, these loans become delinquent if the loan is not paid off at the balloon date. Unlike residential mortgages, I know a lot of you guys that watch my channel, come over here just for residential loans, basically. Residential mortgages, you just have regular straight up 30-year fixed mortgages, 15, 20, whatever the case is, right? But in commercial real estate, all of these loans have balloon payments. So these loans might have a maturity of, say, 5, 7, or 10 years, but with a 30-year payment. So obviously, the payment is a lot smaller. So at the end of the maturity date, they need to be paid in full. Obviously, most of them are refinanced. But with interest rates the way that they are now, and with the occupancy levels being so low, it doesn't really make sense for a lot of these landlords to really refinance any of this debt anymore. So they might as well just walk away from it. Anyways, just about 800 miles south, this my second example, in Miami, which is the hottest real estate market in the country, commercial real estate is also seeing the effects of the high interest rates and some of this tight credit. For example, Genting Malaysia, which is one of the world's biggest casino holders, is having problems selling what's considered some of Miami's most prime real estate. This is a 15.5 acre piece of land in downtown Miami. And after having a deal locked in for $1.2 billion to sell the land, that deal fell through back in June. And according to a lot of reports, the company has not received anywhere close to that price. Commercial real estate is really extremely sensitive to a hike in interest rates, especially because developing land, it just costs a lot of money. Developers really have to pay a lot of interest for years on the construction loans before these projects can finally start producing any cash flow. And look, I know what you're thinking, that, well, it's not really the everyday person who owns these large-scale commercial real estate buildings, so let's not feel bad about it. After all, whatever, right? The most commercial loans are non-recourse loans, meaning that in the event of default, if the borrower defaulted on their obligation to repay, the unpaid balance of the loan, as well as, any accrued interest and attorney fees, the lender cannot really pursue the borrower personally to collect the debt. Here's the thing, is that when commercial real estate crashes, it can really have a bad trickle-down effect on the local economy. So, for example, you'll see a lot of job losses, as eventually businesses will be closing or downsizing, especially in industries like retail and hospitality. But also, as property values go down, that also results in lower tax revenues for the local government, which eventually will lead to budget cuts. They'll reduce public services, infrastructure development. While at the same time, a large amount of vacant properties tends to attract vandalism and illegal activity. So there's always that little bit of a safety concern. Anyways, there you have it, guys. I, for one, don't think that, things are looking very positively, and I will definitely be on the lookout as the situation continues to unfold, whether, it's a temporary downturn or the beginning of a prolonged slump. It remains to be seen. We have seen the Federal Reserve just bail out banks, bail out homeowners, and, who's to say that they might not bail out commercial real estate? So anyways, I hope you guys liked the video, found it informative. Let me know in the comments below. Give it a like, subscribe to the channel, the whole thing. And I will see you guys in the next video. Thank you for watching.